welcome to Street Check, the best podcast in the history of Cabot Wealth Network. I am Chris Preston, editor-in-chief and chief analyst of Cabot Stock of the Week. Thanks for joining us.
I'm Brad Simmerman, web editor and chief analyst of the Cabot Wealth Daily. This week, we are going to start off by discussing the 8-day rally, maybe 9 out of 10, depending on how today closes. Talk about Chinese outflows, specifically the foreign direct investment having the first negative print ever. We will talk about Warren Buffett sitting on a massive $157 billion pile of cash. And then we'll wrap up with a little bit of year-end tax planning, tax tip kind of ideas. But before we get there, Chris, you have what you're looking for the resumption of the bull market rally. I'm going to let you take it from there.
Yeah, so there's a big difference between the major market indexes, the S&P, the NASDAQ. That's the benchmarks that people go by. And if you look at just those, S&P is up 13.6% as of this recording year to date. Seems pretty good, right? But we know that the Magnificent Seven mega cap stocks, Nvidia, Apple, Tesla, those have the lion's share of the returns this year. They've really been driving that return. The S&P, the better measure is the S&P equal weight, which is up a mere 1.2% year to date. So we've had a good couple of weeks here. We'll talk about it in a minute. I think the way you'll know that this market rally is real and sustainable is if the S&P equal weight gets above its 200-day line. And right now it is about 4.5% below that. We're at 56.44. And about 5,900 is the 200-day moving average. If we get back above that, last time we were above that was in mid-September and all through the summer, then I think this rally will have some teeth. So we got about 4.5% to go. That's the indicator I'm looking for to see how much staying power this market rally has.
All right, we'll call it there. Pretty close to hitting the post. I started my timer a little bit late, but yeah, it's a good transition, I think, into our conversation around just general market performance to start the month of November. I mean, we had a really, really quick rally off of the October lows from the 27th. S&P was at 41.17. That's 6% higher now. Right now, the S&P is up 0.2%. It's up about 28 points. So it's still sort of bumping its head against where it's been for most of the month. What takeaways do we have for what has been it's not nothing to string together a bunch of good days, but we're not making a ton of overhead progress. What are your thoughts there?
Yeah, I mean, look, when we sat here 2 weeks ago on our 2 Fridays ago during our podcast then, and that was right at the October low, things felt pretty grim. Now we both have been optimistic that a turnaround was coming. So if you had told us, 9 of the next 10 days, potentially the next 2 weeks, 9 of the 10 days in those 2 weeks would be up days, which they are as of now, we're taking that. I mean, that's something. But the reason I bring up the equal weight is because that really is a better gauge and has been a better gauge of what's really happening in the market because of the influence of those 7 to 10 largest tech stocks. Just to give it even more context, the equal weight, as I mentioned, up about 1% so far this year, down 14% in the last 2 years, versus the S&P down about 7% in the last 2 years. So, technically we reached a bull market in May, and we're still technically in a bull market. But it hasn't felt, I think, who was it? Peter Lynch called this a 2-year stealth bear market. That really is what it is. It basically has been, if it weren't for those 7 stocks, this is 2 years of a bear market. So that's why I'm optimistic about the upside. But I do think, while the last 2 weeks certainly is an encouraging sign, we still have a little ways to go, by my calculations, 4.5% in the equal weight to really start to believe in this rally.
Yeah, I do think, we talked a little bit about being sort of channel bound, where the market's been kind of just grinding lower with varying degrees of volatility since the July highs, um, put in that bottom at the end of October, and then bounce back, and now we're sort of above the downtrending channel, but not really making net progress over it. Um, I'm gonna give you three pitches for technical moves that we could see sort of into the beginning of 2024, end of this year. One pitch would be that the market it's testing its upside and is just going to resume its downtrend, right? Like that's sort of worst case scenario would be us breaking below these levels and then falling, maybe testing the October lows before breaking lower and just resuming that downtrend. That's sort of the worst case scenario.
Yep.
Um, the more maybe middle of the road scenario would be that we set up what would be an inverted head and shoulders pattern. There are not a ton of catalysts on the calendar going into the holiday season. We're sort of relying on the market seasonality, Santa rally tailwinds. But if the market drifts a little bit lower heading into Thanksgiving, maybe getting back to like that 4,200 level, which has been really important support, if it finds support there and then bounces higher, you get an inverted head and shoulders, possibly, which is a
Yep.
good reversal indicator for a potential resumption of that uptrend that started really back in March. And then the sort of most bullish outcome would be that the October low on the 27th was actually the period low, and that what we're going to do is we're going to break out above the range that we've been sort of stuck in trading flat for the last couple of days. We're just sort of hanging at that 43.75 level within a few points. I think if we saw a bullish breakout over the 4,400 level, that would be a green flag for me to really start
Yep.
recommitting capital to the market. Anything else is just going to sort of play out over the balance of the year. So that's sort of where those are sort of the three different outcomes that I'm sort of looking at and trying to read the tea leaves on a little bit. I really don't have a strong feeling in any direction on those. I'm very much in a wait and see mode right now.
Yeah, I mean yeah, you're right. There aren't, the biggest catalysts may have already happened just with the Fed. So the Fed speak being more, muted and maybe possibly less hawkish. That's already kind of passed. Although they can always come back and be more hawkish, which they tend to do in the
Yeah,
coming
and
weeks.
Powell said as much on Thursday.
Yeah, right.
He came out and said, "Hey, we can raise rates if necessary." How much of that is language just trying to like tamp down the market, specifically paying attention to the Fed, which he called out as something that they don't want to see, right? You don't want to see
Yeah.
yields go down because the Fed signals it's done hiking rates. You want to see yields go down because the demand for treasuries is there.
Yeah. I think the biggest catalyst in the short term is simply uh, the time, the length of this bear market. I mean, it, like I said, at what point has it actually felt like a real bull market during the last 2 years? Probably really just maybe June and July, when it wasn't
Yeah.
just when the AI stocks and some others got going. It actually felt like a real true bull market for 2 months there. But outside of that, it has never felt like that and hasn't been outside of, those seven stocks basically. So I think the catalyst may just be, a lot of money sitting on the sidelines, which we'll get to in a minute. But let's get to China. That's number two in our big three, well, four this week. As you mentioned, Chinese had outflows, foreign investment outflows for the first time ever in quarter century worth of data, going back to 1998. $11.8 billion came or outflows from the Chinese economy this is in Q3, so through the end of
Mhm.
September. We had Larry Chung on, Chinese investing expert, 2 weeks ago. And one of the first question I asked him was, he had just spent 2 weeks in China. What you're seeing on the ground there not nearly as bad as what Western American investors envision or or sentiment towards China is, and he said yes, essentially, and that's kind of been my thinking, and why it's sort of been appealing to me as a contrarian play. What's your how would you approach the fact that there this record outflow in the third quarter?
So I read a note from Goldman that was essentially attributing it to repatriating earnings.
Yeah.
So it's less of a closing out existing investments and clawing back whatever you can to get out of China, and maybe more, hey, we're going to start. It's like when you're on a good run in blackjack and it's like, okay, well, I'm going to start pocketing chips, right? So like maintaining some exposure but not upping your stakes is sort of what I interpreted the Goldman note to say. There are look, China's tough, right? There's data opacity issues. You have, I believe, there was a Japanese CEO that was taken into custody. I may be conflating some story there. You've got export controls on chips, right? It's still sort of a hairy relationship that we're trying to work through.
Biden meeting with Xi next Wednesday, so first time in a while. So that's something. I don't know how much that's
yeah.
for.
That could be maybe a sign that China is more concerned about its economic strength than they were coming into the year, right? You can't take quite as oppositional of a position if you really need global investment. I've seen headlines about Chinese exports jumping because of soft domestic demand for a lot of materials, specifically exports going to like Vietnam were much higher than expected. But that also discounts what is the second largest economy in the world, right? It's not like China is like we're going to move on and then China will stop being a country and stop presenting opportunities. So there's the old saying, right? Buy when others are fearful.
Yeah.
So
be greedy when others are fearful.
Yeah, be greedy when others are fearful, and fearful when others are greedy. So with foreign direct investment coming down in China, with some of the big players sort of pulling back a little bit, or at least pulling chips off the table, I wanted to look and see if we could identify maybe some potential contrarian plays. And I've got a couple here that are both buy rated by covering analysts. Both have a good track record of share buybacks in the last year, and both are in the consumer lending sector, specifically because if you have, the largest balance of savings in China is real estate. If you've got difficulty in real estate, you probably have a consumer that's feeling the pinch a little bit. So I looked at two consumer fintech names that are specifically connect borrowers and lenders, or do the lending themselves. QFIN, which is, I believe, pronounced Kifu, and then FINV, which is Finvolution. Both trade right around 4 times earnings. Finvolution, 4.4% dividend yield, and QFIN has a 5.3% dividend yield. So they're both paying you to sort of to wait out the storm and wait out the uncertainty. They both have, I don't want to call them red flags, but things to be on the lookout for, because they are reporting earnings in the next 2 weeks, each of the two companies. The two things that I wanted to flag would be with Finvolution. They have a big AI exposure. And you mentioned Larry Chung, who we spoke to a couple of weeks ago. One of the things that he pointed out was that Chinese regulators will crack down on technology, especially if it's technology that doesn't have a high degree of visibility, like AI, like the black box element where you put data in and get results without necessarily understanding where that's coming from. So they have a higher exposure to AI. It's part of their business model. That's a potential risk. They also have, this is more on the positive side, they have a large insider holding. It's upwards of 45%, I believe. So not only has the company been buying back shares, but they've been buying back shares as well. With QFIN, my concern is more the institutional stake. It's 49% institutionally owned. So if these foreign direct investment outflows are precursors to larger outflows going forward, you could start seeing companies selling pre-existing positions. So there's maybe some bearish exposure there. But if I was looking to add exposure to China, those are two names that I like, at least for my watch list going into earnings.
Yeah, and I'll just mention the two the one I've been hammering, BYDDY is the US ticker symbol. BYD, as Larry talked about, the dominant electric vehicle maker there, sort of the Tesla of China. In fact, it just overtook Tesla in terms of revenues in the third quarter. It's a big reason why Tesla's been lowering prices and margins have come down, and why it's sort of been losing some steam, because BYD is sort of eating away, especially in China, mostly in China. So I still really love BYD as a Chinese stock. And then the one that Larry mentioned, Pinduoduo, PDD, ticker symbol, sort of the smaller e-commerce play there, and Alibaba being the big one, but PDD, and PDD's got a nice bump the last couple of weeks. So yeah, I like China as a contrarian play. And this data is coming from, it ended at the end of September, goes through the end of September. Two of those months were bad months for the US market, and a time to be deleveraging risk. So there's no greater risk ostensibly for US investors than investing in China. But I think what's actually happening in China, as Larry said, is much better than how it's perceived here.
Yeah, I think maybe some of the emerging markets where you have greater risk of expatriation of or expropriation of assets, like with miners and stuff like that, it is probably a higher risk. And you've got that steps back with China a little bit, because as much as there are concerns about party intervention, they're not quite as likely to seize like U.S. corporate assets or foreign corporate assets, especially if they're soliciting outside global investment, if their own economic demand isn't quite as strong as it had been or it had been projected to be. But it's not as if these problems are unique to China either, right? The Fed is explicitly is explicitly trying to make U.S. households spend less money, feel the pinch, feel a little bit of weakness. We're seeing the same thing in Europe, where inflation is continuing to be a problem. So I don't know that you're necessarily upping your risk to a weak consumer by looking overseas, but I do think there's a contrarian play possibility if others are becoming very reticent or are scared of even playing in those waters.
Yeah. Okay, let's return back to U.S. shores with number 3. Warren Buffett has a cash hoard that he's not had in how long it's been? $157 billion in cash, right? Which is the most he's had since, I don't.
It might be ever.
Ever?
I don't know for sure.
Yeah, maybe inflation adjusted, not ever, but total amount ever. $157 billion. I guess that prompted a question from us. Should you also, just average individual investor, or should we also be deep in cash right now? So Mike Santolos, who runs our Cabot Growth Investor, Cabot Top 10 Trader, is sort of my gauge for this. He goes pretty heavily into cash when the market is too risky, or is just in plain free fall or semi free fall like it was in October. He went by the end of last month, he was down to about 75% in cash. He's now he's deployed some of that cash. He's up to about 60%. I like cash is definitely a good way to go in markets like this. But as we just talked about, things have perked up a bit, and we're not constricted the way that Warren Buffett is, right? He goes elephant searching, and he needs to have a certain amount of cash to be able to, buy out companies that are going to be worth his investment.
Yeah, absolutely. So the 157 billion is a record cash for Berkshire. The closest total was in 2021, 149 billion in cash.
When in
Um,
2021, do you know? Did it say?
it was third quarter of 2021. So
Smart.
yeah, my guess is he saw rising valuations and was like, all right, well, let's reduce our exposure. Um, the market was certainly exuberant, and he is a value investor. He's still a cigar butt investor. He's still looking to extract value where he can, but he also tends to prioritize companies that are clearly valuable or maybe are distressed. It's not like he can go out and go sort of window shopping. We talked about three Chinese names. What's he going to do? Go buy $20 million worth of Finvolution? No, that's not going to be a material impact on the Berkshire portfolio at all. The only way for him to get that kind of the only way for him to get material performance is to make significant investments. And there are structural problems with trying to deploy something like 10 or 15 or 30 billion dollars in cash.
Yeah.
He can't be as nimble as individual investors can. Uh, you know, you had an opportunity, or we had an opportunity as investors to pick up 10% off the October lows, give or take, right? Depending on which stock you were in. We're seeing some some companies that are reporting earnings take 30% haircuts. We're seeing some pop 20, 30%. He can't make that type of investment with the cash hoard, or with the cash haul that he has on hand. It's just not practical for him.
Yeah.
And if we're in a period of maybe weakness into the next year, it's not as if he doesn't have a time limit on how long he can hold that cash. He can start looking for
Well,
actual
he kind of does, but
well,
yeah.
okay. So Berkshire doesn't have a time limit on when
Right.
it has to deploy the
Right.
cash.
Yeah.
So right, there's not necessarily any urgency. The big drivers for the market have been the Magnificent Seven. He has exposure to Apple already. That's one of his big core holdings, if I recall correctly. I don't have percentages or dollar amounts. He's got exposure to oil. Took a big stake in what was I can't think of the name of the company right now. He's got Occidental. He's got big exposure to Occidental. He's got exposure to financials. So like all the stuff that is either strongly performing or has been performing well this year, or with his bank exposure, stuff that's already been beaten down. He's got all of that. He can sit on his hands and look for even better opportunities if we stay either in a stagnant market, or if the market declines when we start running into some economic weakness as the Fed is trying to engineer. So it's easier for him, rather than looking for these small little opportunities that aren't really going to make a difference. Easier for him to sit on cash and start looking for things that are going to be home runs for him home runs for Berkshire over the next 5 or 10 years.
Yeah. And, he's probably waiting for some of the things that we're waiting for, to see a market he can believe in. 2 weeks of an improved market are good, but not quite enough to erase, what's happened the last 3 months. I imagine he'll start putting that to use if the market gets to, you talked about S&P being above 4,400, and I talked about equal weight being above his 200-day average. Maybe once we get there, I could see him using it more. But as an individual investor yourself, you have the ability to start deploying some of your cash earlier than that, obviously.
And you can be nimble.
That even 60% with Mike's portfolio seems, that's on the higher end. If you're not strictly a growth investor, you can afford to have much more of your cash deployed towards stocks.
Yeah, and Buffett's not looking for a 2-week rally. He can't even deploy a meaningful amount of capital in 2 weeks. It's going to take him it'll take him a month for Berkshire to go out and buy stuff, or to put deals together to get to take on large positions. So he's got the luxury of time without a ton of maybe obvious opportunity. And I do think at his heart he's a little bit of a vulture investor. And he's got a really good PR team, right? He's Uncle Warren to so many, but he's looking for companies that are highly distressed. And there are I've seen credible reporting that there's a lot of zombie companies that are running around right now. I wouldn't be surprised to see him start deploying some of that capital when some of the debt maturities are approaching. So we're coming out of a period of historically low interest rates. Companies that might have been paying 5.25% or 5% on large bond positions are now having to recapitalize at 8%. It's becoming a lot more expensive to do business. And that's the kind of environment where he's going to step in and deploy cash. That's exactly what he did in the great financial crisis when he engineered a deal with Goldman. He got better terms than the US government did because he had dry powder. So I do think that you can sort of set aside the Berkshire cash position as an individual investor because of the structural difficulties in using it.
Right. Okay, let's move on to our final item. You talked about a couple end of year sort of tax tricks as investors can use, tax loss selling, but you had some sort of nuances with that. Talk about what are some strategies people can use to avoid the tax man the next few weeks.
All right, so this goes sort of hand in hand with what I believe you said, Peter Lynch said was essentially a 2-year bear market,
Yeah.
right? If you're sitting in the S&P Equal Weight Index, or if you're sitting on assets that have performed similarly to that, where you haven't been able to take advantage of the Magnificent Seven rally, you are probably sitting on losses if you bought in 2021, maybe even if you bought in 2020. All right, so what can you do to help improve your tax picture, right? Wages are higher now than they were then. I just saw that the IRS released their new brackets. I don't know what they are, but if you've seen your wages run up and you're a little bit concerned about the tax bill that's coming due, what can you do? One of those things, tax loss harvesting, right? You sell assets that have underperformed or where you've got capital losses, and you can use that to offset a portion of your income. The reason that I wanted to talk about this today, instead of waiting till closer to the end of the year, is there's a deadline on one element of that, which is avoiding triggering the wash sale rule. Wash sale rule is where you sell a security at a loss and then you buy it back. You're not allowed to realize that loss on your taxes unless you wait at least 30 days to buy back the security or a substantially similar security. And that's across account types. So if I've got a loss in I don't know, Expensify, I can't sell it and then buy it in my IRA. I can't buy options on Expensify. All I can do, what I have to do is I have to wait 30 days before I can buy it. So that's what the IRS will allow you to do. Per Wells Fargo, and double check with an accountant if you're considering this, November 28th is your deadline to sell something for a loss and be able to rebuy it in the end of the year. And if we stay in a relatively boring kind of flat market, you're really not missing out on a lot of upside opportunity. So if you're looking to do some tax loss harvesting, you've got about 2.5 weeks to start doing that. And then you could feasibly buy the position back in the same account or in a different account, or buy a substantially similar security. Something like a call option works, right? Like we've got low volatility levels, so time and volatility premiums are low. So if you're bullish on something but it's underperformed of late, you sell, you take the loss, you wait till day 31, buy some call options on it, then you've still got some upside exposure, but your capital's not as much at risk. Or you buy it back at what will probably be close to the same price. I don't have a crystal ball. Maybe the market rallies 10% from here and you feel like you missed out, but that is one opportunity to cut the bite of the tax bill a little bit. The other one that I wanted to touch base on is, again, sort of reliant on that rolling 2-year bear market or bearish market.
Stealth bear market, I think, is what Lynch called it. Yeah.
What was it?
Stealth bear market.
Stealth bear market. All right.
Yeah.
So stealth bear market, if you're looking at doing a Roth conversion, right? So you take IRA assets, you move them to a Roth IRA, you pay taxes on the value of the assets, but then they grow tax-free, and then you don't have to pay taxes on your distributions. So it's a popular strategy. If you're in a period where you have maybe a lower income, maybe you didn't get as big of a bonus, right? So what you do is you essentially prepay taxes on the assets. Where it's doubly valuable is if you're in a long-term holding that has maybe been pulled lower by the stealth bear market. So let's say you have an underperforming stock that you've been in for a long time that you're bullish on. Maybe it gives a really good dividend yield. Maybe it's the kind of stock that you're just going to buy and hold forever. If it hasn't participated in the rally, but you think there's upside on it, you can move it in kind at a depressed price into a Roth IRA, and essentially you're paying a lower tax bill because the performance hasn't been as great. You don't sell the asset, you move the shares in a, 1-for-1 into the Roth IRA, and you end up paying a lower tax bill on the investment because the investment is at a lower price point. So it's not, it's not going to make you rich, but it does offer you a lot more potential upside, especially if you think maybe the next bull market resumes mid 2024, maybe later next year. Something that you feel is fairly valued, still worth owning is the important thing, right? If it's a stock you don't want to own, sell it. But if it's a stock you like and that you feel is sort of unfairly beaten down, consider converting that to a Roth IRA. You prepay the taxes on it now, let it grow tax-free. It's more valuable for you if you expect that in retirement you're going to be maybe at a higher tax bracket, or if you've got a longer time frame ahead of you before retirement, right? It doesn't benefit you to go from a traditional to a Roth nearly as much if you're going to be paying comparable tax rates and you're going to be drawing down on it in the next couple of years. But if you've got a long time horizon and you're in maybe a lower bracket and the assets are beaten down, it can help your assets grow into retirement even better than just holding it in your traditional IRA.
You might be smarter without the beard. Yeah. Like you might not be the counter indicator that you might as well reel off all your market predictions now until it fully grows back in.
We'll see. If QFin reports earnings and gets crushed, then we'll know that the beard is not a factor. If it skyrockets higher, you might see a clean face.
It's half back in, so it might be hard to tell right now. But that all sounds like good end of year tax advice to me.
And talk to an accountant if you're worried about it. I am not an accountant. I've just worked with them and worked with a lot of financial planners, and I have some good understanding of the tax code, but ultimately it's you and your accountant that's on the hook if you make a mistake. So talk to them.
Yeah, there you go. Okay, so we will be back next week. Obviously, until then, as always, give us a like, subscribe. And if you have any questions, email us streetcheck@cabotwealth.com. We'll be back next week. I believe we'll have Mike Santolo, who we've mentioned many times on this podcast, will be joining us to talk growth. Hopefully we'll have another week's worth of encouraging market data to go by. We'll see. I think this next week will be really pivotal, to determine what's going to happen in the next couple months.
Yeah, I hope so. I really hope that we get strong signs of the Santa rally, because right now it just feels a little bit flat, which is better than down.
Yes,
but it's not nearly as exciting.
No, it feels a little bit like maybe like the first quarter, or maybe like March, April of this year, where it was just flat, kind of boring, and then there was a run up. Maybe we get something like that. But yeah, like you said, flat is better than what we saw from August through October, especially in October. So hopefully things are improving. We'll know a lot more next week. Thanks for joining us, and we will see you again here on Street Check next week.